Well, hello, everybody. I'm Ric Edelman. Thanks for joining us today. Fascinating conversation we're about to have. There is so much confusion, so much uncertainty about what's going to happen to the economy, the financial markets over the next several years. Increasingly, Americans are getting older and more concerned about lifetime income. And that's what this event's going to tell you all about, how to generate lifetime income without using annuities, which is the traditional go-to methodology of doing that. So it's going to be a fascinating conversation. You're going to learn a lot. Happy to bring on to this session Nate Conrad. He is the head of LifeX with Stone Ridge Asset Management. Nate, good to be with you. Good to see you again.
Thanks for having me, Rick. Excited to be here today.
Nate, prior to his role at LifeX, was the president of NYDIG, which is one of the most important crypto companies in the industry. But he came from TradFi, like so many others, with a stint at Goldman Sachs after getting his degree at University of Pennsylvania. Nate, not everybody's familiar with Stone Ridge. It's an unusual ETF provider compared to most that are out there, a very influential one. Tell everybody a little bit about Stone Ridge and LifeX before we get started.
Sure. So Stone Ridge, we're an asset manager north of $25 billion in assets under management. To the extent you haven't heard of us, that's probably because historically we've had a no press policy, and we try and stay quiet and really just focus on creating great products and great return streams for investors. And when you look at some of the products that we do on the slide, reinsurance, natural gas, art, there may not be a common theme until you really kind of think about it and get to know us. And the theme from our perspective is these are all things that come together to help create a better sense of financial security for investors. Most of the products, they're designed to be uncorrelated to traditional stocks and bonds, but still very attractive ways to earn a return on your investment. And we also have, with LifeX, another way of creating financial security through reliable monthly income. So for us, the journey is really all about helping as many Americans as possible create financial security to get themselves to and through retirement. And when we say as many people as possible, one big theme of that is how do we help people, in public ETF or mutual fund form factors where you don't have to be an AI or a QP, so that we're helping people up and down the wealth spectrum.
What's worth noting here is that Stone Ridge is offering true alternatives in the sense that these are asset classes that are typically unavailable to ordinary investors. Most financial advisors don't have a really effective, easy, low-cost way of accessing them. And it's this kind of out-of-the-box thinking that I think led Ross Stevens, your CEO and founder, and you, Nate, to creating the LifeX series of ETFs. So I'm really glad we're going to be spending our time talking about this. And as we do, I invite you to join the conversation. Many of you have already submitted questions when you registered for the event. I'll be peppering Nate with those as we go. And you have an opportunity to add questions here. Just go into the Q&A box here on Zoom. I'll be curating that as we go. And as I see something that's relevant or something that I think might stump Nate, I'll toss it up to him as well. Uh, so let's begin with the fundamentals of this. When we talk about generating lifetime income for retirees, this conversation, Nate, is all about longevity. It's the fact that, 50 years ago, we didn't have to have this conversation because nobody was going to live terribly long. Today, people are living routinely into their 80s and 90s, and it's widely projected that people alive today are going to live to age 100 and beyond, running the real question, will I last longer than my money does? And that's why people are really, really concerned about generating lifetime income. Talk about this whole concept of the focus on lifetime income, the issue of longevity, what you're hearing from advisors, and so on.
Sure. Yeah, it's such an important topic. I'm personally deeply passionate about it, as I know you are, Rick. And a lot of it comes back to what you said, this fear of, am I going to live longer than my money? And it's a tragic and really terrifying question when you put yourselves in the shoes of that 77-year-old client who, saved their whole life to build up, maybe $1, $2 million, maybe more if they've done really well to get themselves through that period. And nobody wants to go from that sort of a journey to, in their very later years, being a financial burden on their family. or living in a way that is just so far below the means that they had along the way and really losing dignity in retirement. That's a tragedy. It's a tragedy that people should, in their 70s and 80s, spend their time having to worry about that instead of enjoying that time, with their friends and making the most of it. And so the challenge from our perspective, for all the reasons you mentioned around increasing life expectancy, keeps getting harder and harder. People might have been saving, thinking retirement could be a 10-year journey, and now they're staring down the face of a 30-year journey. So that time component is massive. You also have big concerns around inflation. There's a high inflation print this morning, and inflation over the course of 20 or 30 years turns a dollar into 50 cents of spending power pretty fast. And then you also don't know, what are you going to get in returns from your investment portfolio? And when you have a bad decade in investments, that puts a lot of financial plans under stress too. So fundamentally, huge uncertainties in the lifespan, the investments, the inflation, maybe even what Social Security is going to be around and doing in the future. And the challenge for the financial advice industry is, how do we help people go into this world of unpredictability and find ways to create simple, reliable solutions so that people can actually sleep well at night and enjoy retirement. And if we can't do that, then as an industry, we're really failing them.
So a lot to unpack there, Nate. That was great info. Let me first focus on one of the things you said there regarding the 60/40 portfolio. I mean, we spend our careers helping our clients accumulate assets, and most of us are using a 60/40 portfolio, or, give or take, somewhere in that range. And we understand diversification, and we're rebalancing, and we're doing a really good job at accumulating wealth for our clients, both between growth of the portfolio as well as the client's continuing addition of funds, their current contributions to their 401k and what have you. So what's wrong with that? Why do we need an alternative solution at some point? Why not just continue with that 60/40 for as long as the client lives? The whole 4% rule, where once they're in retirement, instead of adding to the portfolio, they begin to withdraw from it at the rate of 4% a year. Why is that insufficient to solve the problem?
Sure. So to me, there are really two big problems under the hood. So one problem is just the reality that people get nervous once they don't have that paycheck anymore and that portfolio is all they have. It becomes a lot scarier when the stock market takes a tumble and you see that nest egg start to shrink, and that starts to raise the prospect of, am I going to outlive my money? Am I going to have to cut back? And so you see people start saying, I'm going to de-risk my portfolio from 60/40 to 50/50 or 40/60, and they reduce the amount of growth assets in the portfolio. But if you're going to make sure that you're going to be okay, even if you live a long time, you actually need that higher returning growth segment of the portfolio if you're going to beat inflation and be okay for 20, 30 years if you have a longer than life expectancy outcome. And so the de-risking and the human fears, around that, which are totally rational, that's one big challenge. There's a related challenge, which is that the outcomes of a 60/40 portfolio totally change in a world where you're withdrawing over time instead of adding over time. There's a ton of great academic work on this, that having to sell down your portfolio over time hurts the outcomes, because as the equity market zigs and zags and you're selling down, you are hurting the compounding, as opposed to being able to stay and enjoy the, very reliable historical outperformance it delivers. If you can be in there for 10, 20, 30 years, you can compound wealth a lot. But if you're selling in years 1, 2, 3, 4, 5 as the market's zigging and zagging, it's a different world. And so the path to the solution to me is not that everything's totally wrong, but rather, how do we start to create a baseline layer of cash flow to support the withdrawals so that we're not selling down the higher returning assets, and through that create peace of mind so that the allocation to the growth assets doesn't shrink. We can keep people with the higher returning assets in the portfolio by really leaning more heavily on the way we access fixed income to solve the cash flow needs.
So it would seem, I think everybody's kind of already thinking this in their heads, that the two most common approaches to deal with what you've just described is either a bond ladder or an annuity. So talk about what's wrong with just doing one of or both of those.
So those are both great places for the mind to go when we start thinking about how to create, reliable baseline income. And for me, it's very helpful to think about buying an annuity as really two things packaged together in one. So I like to think of buying an annuity, different types of annuities out there for sure, but think of buying, an annuity that is a pure income stream. When you're buying something like a lifetime income annuity, you're really buying a bond ladder with mortality credits on top. It's two products in one. It's a monthly paycheck based on what fixed income can produce, and then it's extra value on top because it goes away when you die. So it's those two things bundled together in one. And for some people, that's a great product. For some people, that's not a great product based on health situation, liquidity needs. And for everybody, it's just a lot more to think about to make those two decisions bundled in one versus just making the bond ladder decision. And when you think about a client in a 60-40 portfolio, the 40 is fixed income. And the question is, what's the right way to own fixed income? And I will personally make the case to anybody who will listen that when you're in that phase of life where you're relying on the cash flow of your portfolio, owning your fixed income within a laddering strategy is strictly better than the way most people own their fixed income. To me, laddering is a free lunch. It's a free lunch both mathematically in that it lets you get cash flow out with reduced risk by getting things out as they mature instead of selling at an uncertain market price. So there's kind of a mathematical efficiency. And then there's a kind of a human and a behavioral finance efficiency that knowing you're getting a certain amount of money at a certain point in time and getting it over and over and over, and knowing that even if interest rates rise, you can hold to maturity and get your money back at par without a loss, is a totally different way for people to create certainty and reliability in their portfolio. So to me, the first decision is, why do I own any fixed income in my 60-40 that's not laddered if I'm in that part of life? And then the next question is, do I want that in a pure play bond ladder way of doing that? Or do I want to bolt on mortality credits on top or some other way of turbocharging that income?
And as soon as you deal with the annuity issue, I mean, everybody loves the idea of the philosophical concept of an annuity. I mean, what's not to love? Guaranteed income for life. When you drill into the product, though, is where people begin to start to have objections: the fees, the lack of liquidity, the high taxation, the fact that the income isn't adjusted for inflation in most cases, that the income is only as strong as the insurance company's ability or willingness to pay, which is a big problem because the mortality data, the actuarial basis for a lot of these contracts, isn't assuming the client's going to live to 100. They're often assuming the clients are going to live a lot less. So what happens if everybody does get to age 100 and the annuity isn't able to pay out the benefits that are so-called guaranteed? These are all crises that are coming over the next couple of decades with these products. And this is why I think so many are turning or seeking alternatives. And there frankly aren't a lot of alternatives in the marketplace to either the annuity product, challenged as it is with its negatives, or the bond laddering, which is also got a significant number of limitations, not least of which is how much are you going to have to allocate out of that 40% of the portfolio into it. That introduces the solution you guys have come up with. So explain to folks who are unfamiliar with LifeX how your ETFs work, how they're designed to solve the problem of guaranteed lifetime income.
So what we've built at LifeX, we've built a suite of ETFs, and each ETF really delivers you all of the benefits of a bond ladder that is based solely on US government bonds, but in the convenience of a single ETF. So for example, we have a ETF that goes through the end of 2035. Its ticker is LDDR for ladder. And if you buy that product, you get the same amount of money in distributions every single month through the end of 2035, through December 2035. And so you can go out and you can cover your client with a set amount of monthly cash flow for the next decade by buying a single ticker. and it's government bonds. It's about as conservative as you can go in terms of trying to create that cash flow stream. And we're doing all of the hard work for you to make sure that it's the same amount of money every month. And we're amortizing the principal along the way. So you get to enjoy the principal along the way instead of it being lump sum at the end. And as a result, that fund has something like an 11% cash flow yield because it's giving you the treasury yield of 4% plus a bunch of your capital along the way. And if you have a client who says, if I could just cover that first decade so I don't have to worry about my equity book and that can stay invested for the long time, now you have a one-click solution to cover that next decade of income. We have solutions ranging all the way out to 2065.
And that's what I was just going to ask, because the product to 2035, 10 years worth of income, at the end of the 10 years, there's nothing left because you've received your interest and your principal during the 10-year period. So there's nothing left at the end of 10 years. That's great if you're already 90 or 95, but if you're not yet that old, that product is of limited utility because at the end of 10 years, it's gone. So you have products that go out not just 10 years, but you started to say all the way out to how many years?
2065, which would cover you for the next 40 years. And, the way we think about it, to a first order, if you're 60-40, today is stocks and then 40% of, call it a normal bond fund that tracks a intermediate benchmark. It could look something like 60% stocks, 40% 2035 ETF or 2045 ETF. And even if that ETF goes to zero by 2035 or 2040, it helps you not touch the equities and let those grow and compound. And then you can rebalance and top up. And instead of, taking your, call it 4% rule, selling pro rata of the portfolio, now you're getting it all in a safe, no volatility way from the lowest returning asset, and you're freeing the highest returning assets up to stay and compound without having to sell along the way. And now you're giving people the ability to invest in the higher returning assets, but not worry about the drawdowns along the way.
Yeah, in other words, if I have a high degree of confidence of knowing that I'm going to get this monthly distribution for the next 40 years, then there's no reason to suspect it because it's entirely U.S. Treasuries. So I'm going to get the monthly distributions. I'm going to do it for 40 years. Now I don't have to worry about needing to tap into the rest of the portfolio, which means I think psychologically I can be more willing to invest the rest of the portfolio into equities where I'll get better returns than if I had a whole bunch of bonds in that segment. Is that kind of where you're coming from?
That's exactly right. And the way some advisors use it is they call those clients who had already de-risked and they went down from 60-40 to 40-60 and they say, hey, if we can do this, would that help you feel safer going back to 50-50 or back to 60-40 and start to dial risk back up? That's going to mean better outcomes for that client in the long term if equities do beat cash over the next 10, 20, 30 years, which I think most people think is pretty likely. And it's also going to mean more AUM growth for the advisor because you've served that client better and you're charging your asset-based fee on a growing pool of money.
So you'd mentioned that the 10-year ETF has a distribution of around 11%. What's the distribution rate on the 40-year version?
So the 40-year version is probably on the order of maybe more like 5-ish% distribution rate. So
and that's because the treasury principal is being distributed over 40 years, not 10. So it's not as compressed.
Exactly. Really from a total return perspective, they all return about the same thing, which is treasuries minus the expense ratio, which is 25 basis points. And they just give you that money over a different period of time, exactly as Rick said. And if you ever want to know the rates, you can just go to our website, lifexfunds.com, and you can see it all every day in real time. It's totally transparent because they're ETFs, and it'll show you if you want to invest 100K, how much you can get based on the horizon. And you can also choose, do I want to get a fixed amount of money, nominal, or do you want to get an inflation-linked amount that will be a real income stream? And there's just a different ticker based on which one you want.
The one that's inflation-based would have a lower distribution rate today, but would rise over time.
That's exactly right.
We've just pushed out the link to your website that has all this information. So go to the chat box here on Zoom and you'll be able to access all that info. So talk about how this translates into actual practice, Nate. How much of a client's portfolio are you discovering that advisors are generally advising their clients to allocate to this? And how are they figuring that out?
So the short answer is it normally ends up gravitating towards, call it 25% of the portfolio, or maybe about half of the fixed income book. And they get there in a couple of ways, and different paths to it. One way to do it is to look at the financial plan and just see how much people want to spend and how much of that they will really lose sleep if they're worried about being able to do that. And if you cover those, needs, the wants with LifeX, it's generally going to wind up in about that allocation. And quite often in life, it's nice to crawl and walk before you run. And so people might start with a 10% allocation, give the client a couple months to experience the product, get the cash flows, and then work it higher over time. And then see, sometimes once people say, wow, I can spend 6% or 7% of my investment this way, maybe I want more of that and I want to take less risk and just have more certainty. Maybe they say, you know what, if I can really cover this, I want to swing for the fences and try and leave a really giant legacy to make a real impact on the world, or leave something behind for my kids. So people react to it very differently. But it, I think in every case, really equips the financial advisor to show up with solutions to the client concerns. When they come in and they say, I'm worried about X or Y or Z, good chance you can answer that here, and good chance you can redirect it and say, what's really important to you, and how do we go pursue your goals with confidence? And here's a way to help create some confidence about how we pursue those goals, whether it's what you want to spend, the safety to invest for the long term, or what you want to give away and maybe start giving away sooner, and how you can kind of pre-fund that and set it aside.
So the advisors are generally, 10 to 25% of the fixed income of the portfolio, maybe half of the fixed income allocation.
Exactly.
And which of the ETFs are they generally targeting? Are they trying to get close to what they think is the client's life expectancy?
So we see very different approaches on this point. So there's one group of advisors we've seen that says, just covering the next decade is good enough for me. Feels like a really long time. And, in 5 years, I'll extend it and always just have a bucket covering the first decade so that I'm not having to touch risk assets, and then I'll kind of work my way through it over time. There's another camp that says, I really want to lock in, call it set it and forget it income for the rest of the financial plan. And I want to customize it and target, age 95, age 100 based on that client situation. And those people, more often than not, I would say gravitate to doing it with an inflation protected income stream to really protect that spending power into the later years. Mm-hmm.
And once you make that decision, that's one of the downsides of an annuity. Once you buy that annuity, you're done. You own it for as long as you're around, because many cases you can't sell it no matter what. In other cases, there are huge penalties or adverse tax implications or what have you. Talk about the do-over button with these ETFs. What happens if you later change your mind and you don't want to keep the money that you've invested in the ETF? What happens?
So that's the beauty that really comes from unbundling the value proposition here. When you buy a LifeX ETF, there's no commitment. It's just a treasury ETF. So all of the value comes from owning treasuries and the way we deliver those cash flows, but nothing restricts you from selling at any time. They trade all day long, and so you can always choose to exit. And that can come into practice in a lot of ways that I think are very important for the flexibility in a financial planning journey, where today, if you want to lock in for that client all the way to age 95, as you go through time, their health could be better than they thought, it could be worse, and you have life events that cause you to change that planning horizon, or maybe to change how much they need to spend. And so having that flexibility to say, I used to think I needed to plan till the year 2050. Now I want 2045 or I want 2050. I used to think I wanted nominal income. Now I want inflation protected. All of this, the typical platform, you can go trade an ETF commission free to just get in and out. So having all that flexibility is one more dimension of the peace of mind.
Let's talk about the taxation. Several folks are asking about that issue. You mentioned an 11% distribution rate on the 10-year maturity ETF. So talk about taxes.
Sure. So, I think there's this trap that a lot of retirees fall into when they want to create peace of mind, which is they buy bonds, they don't touch the principal, and they only spend the coupons. This is something that a dear relative of mine told me was his plan of how to create safety. And it feels safe, but it's a terrible tax strategy. Why is that? Well, the coupons you pay your tax on. The principal you can actually take out and spend tax-free. So when you think about what's the best way to get money out of your portfolio from a tax perspective, the answer is you want to get your principal as much as possible. And LifeX makes that really easy for you. So if you buy our 2035 fund, I mentioned that 11% distribution rate. For a lot of your clients, that will probably translate to about 10% after tax, with only 1 point of it being lost to tax. The intuition is you're earning the interest income on US government bonds, call that with some rounding about 4%. If you pay 25% taxes on that 4%, that's a 1% tax bill. Everything else that's not the interest income from the government bonds is generally going to be the tax-free return of your own capital. So if you put in $1 million, you're getting something like 110 grand a year, paying about 10 grand in taxes and getting 100 grand back after tax. So a very high efficiency way of getting money out to spend, as opposed to, I'm selling bonds, I'm selling stocks, I'm paying capital gains, or I'm just living off of the natural cash flow where I'm paying federal, state, and local, and I'm getting 4% and it turns into 3 or 2.
So the downside, though, I mean, that is pretty amazing that you got an 11% distribution and you get to keep 10 of it. That's kind of amazing. But we do need to emphasize, I think, the fact that at the end of the 10 years, there's nothing. The NAV is zero because you've received all of the money, the interest and the principal. And we need to make sure, don't we, that the client fully appreciates the fact that there is no principal balance left. They've spent it.
That's exactly right. That is the number one single biggest education point on the product. We write that pretty clearly in all our materials. We would encourage you to tell your client that. That's the one thing you need to know. And it's great because it also explains why is this not too good to be true. Nobody can make 11% on treasuries. There's got to be catch. The catch is we give you your principal along the way. I'll tell you that's a feature, not a bug. That's how you get the money out so tax efficiently. You got to remember that it ends, and what the benefits of kind of how to make that really easy says right in the fund name, this is your income to 2035. And every time that client looks in their statement, they're going to see the account value based on whatever's left. So when you log in year 9, you're not seeing I invested $1 million. You're seeing, I've got about 110K left that's going to come to me next year, and then this is going to be gone. So because it is totally transparent in the reporting, that should really help avoid any surprises. But always good to mention it, just because this is the only way the product can, really wind up with surprises is if people forget about that. Everything else about it is pretty darn simple and transparent.
Now, you mentioned the tax implications of buying it initially and holding it throughout the entire term, but you also said it's liquid. You could sell it whenever you want. Talk about the potential tax implications and valuation of that. Would you have a capital gain, capital loss? Talk about all that.
Sure. So in a lot of ways, the answer here is pretty much like any other bond ETF. So, if you hold it longer than a year or shorter than a year, that's going to say, is it a long-term or a short-term capital gain or loss? It's a bond fund and it owns intermediate government bonds. So its price is going to move with interest rates. And so if interest rates rise, you would expect that if you sell, that would be a capital loss. If interest rates fall, you would expect you'd sell at a capital gain. The thing that is different than a lot of other ETFs is that the duration, the interest rate duration of the bonds that we own shrinks over time as these funds age. So to use our 2035 fund as an example, it's got about a 5-year interest rate duration today, right in that bogey of intermediate fixed income. But if you check back in 5 years, it won't still have a 5-year duration. It'll have a 2.5-year duration. And so over time, it becomes a kind of a less fluctuating NAV, and it pulls to par because you're just maturing your bonds and getting your money back. And if you hold it all the way to the end, as all the bonds mature, it doesn't really matter what interest rates did because you get your par back at maturity.
A couple of other questions related to all of this we're getting. One, what happens if you die before the term is over?
So the beauty of it just being a bond ladder ETF, absolutely nothing. It's your asset. If you pass away, it flows into your estate like any other ETF. It's not like an annuity where you've made that trade-off to earn the mortality credits. Mortality credits are great in my perspective. It's just a trade-off. And here you're not making that trade-off, so there is no kind of other shoe that drops if you pass away. It's fully liquid to you, it's fully liquid to your estate, it's fully liquid to your heirs.
So the heirs would either continue receiving the monthly distribution or they would sell it and take the proceeds.
Exactly right.
Would this make any sense for using these ETFs inside an IRA account?
So in an IRA, it should work just fine. It's going to fit well within the RMDs. It's going to give you cash that you can use to meet those RMDs. And some advisors have really liked the kind of narrative to the client of, you could kind of turn your IRA into a pension by having your retirement account now produce a retirement income stream. So there's a lot of elegance to that. The key design question, there's no right or wrong answer, but I would just say, when you think about where the assets are for that client, LifeX is very tax efficient, and so it can also go find in a brokerage account if you have the right assets there to do that. And then you could put less tax efficient assets into the IRA. And there could be a tax optimization strategy there for you to do. But if you have the fixed income in the IRA today and you want to use those assets, it works just fine. And there's a nice elegance to how you can explain that to the client.
Charles is asking if you can stop the distributions.
So what you can do if you don't need the money to spend it is you can reinvest. And it works in a nice intuitive way, which is, you invest that $1 million, you're getting 110K a year. If you reinvest it, it's 11% rate today, the income remaining through 2035 is going to compound grow as you reinvest it. So if you're getting 110K and you reinvest that first year, you might get more like 120K in years 2 through 10. The end year doesn't extend if you're reinvesting. You just get more and more money every year from kind of when you start taking it till the end. I think there's a really nice use case there for people who are, let's say, 55, 60 years old. They're not retired yet, but they're thinking about it. If you wait until the day you retire to start working on your lifetime income, you run the risk that interest rates will be very low and you're going to get a really bad deal. Whereas if you think about, hey, maybe I could glide path or I could dollar cost average in over the 5 or 10 years before I retire, to me, that feels a lot safer and really reduces the uncertainty of what you're going to get, because the year before you retire, you've already built up most of that stream you need and you've locked it in. And so if you use our longer horizon funds like our 2060 or 2065 fund, you can start helping people plan for retirement before that day comes. And that feels pretty nice. And then you can just reinvest the distributions until that day they retire. And it's an ETF, not an annuity where you have all the paperwork. So there's really no operational friction if you want to buy this once a week, once a month, once a quarter. It's just a trade.
Arthur's asking, since you talked about tax efficiency, if these distributions are exempt from state income tax.
It's a very astute question. The answer is basically yes. When you own 100% treasuries, effectively, as this fund does, in general, to our knowledge, every state that has state and local taxes, that income will be exempt. So you're really just looking at the federal tax on the treasury interest income.
And related to that, one of our attendees is asking why you chose to use treasuries as the basis for this, as opposed to munis, where they'd be entirely tax-free.
So there would be a little bit of incremental pickup there in munis. That's exactly right. For us, the first objective of this product is really about safety. And so whenever we could make a decision between making the product a little bit safer versus increasing the distribution rate, we've generally always leaned towards safety as the answer. So, the same answer effectively applies to why we didn't do a corporate bond version. When you really want that bedrock income that you can count on, the federal US government bond path is kind of the cleanest, safest, simplest answer that nobody's going to worry about. Whereas if I, had a muni solution to tell you about and California wasn't doing so hot, that starts to raise questions for people, and that's just not what they need. And when you think about the tax efficiency of the product, if you're getting 11% and it turns into 10, the marginal efficiency of doing the munis is not worth that much, but it could really cost you some peace of mind in some bad scenarios. And that's what we're really trying to avoid. We just want people to feel good, to feel the financial security.
Sure. Ryan wants to know about product distribution. Are these ETFs available at most custodians at this point?
They are, yeah. So any place that doesn't have built-in gatekeeping the way some of the wirehouses and so on gatekeep and they don't make them available. Anybody else where they make ETFs available, they're available today. So you can buy them on Schwab, you can buy them on Fidelity, you can buy them on Pershing.
John's got an interesting observation talking about the fact that the fund itself is pretty new, right? When did you launch all of these?
So the majority of them have been operating since January 2024, so a little bit over a year. A couple of the tickers that we added on, as we go through time, we keep adding end years. A couple of them launched a month ago. The majority launched about 13 months ago. So
John is describing that there doesn't seem to be a lot of historical data regarding the funds. And so he's wondering if you're getting concerns from people who are expressing the fact that the fund is relatively new and doesn't have a big, long track record, but these are really just treasuries, right? So talk about John's concern.
Yeah, so normally when people ask about track record, they're probably trying to get at one of a few different things. They might want to assess what's the volatility of the fund, or how certain can I be that the manager can kind of deliver on the investment outcome necessary. And the good news, for the reason you mentioned, Rick, there are lots of ways to answer those questions that doesn't require a 5 or a 10-year track record. This is effectively a held to maturity bond ladder strategy. So if you just look at what we hold today, you can get a pretty good assessment of what's the volatility of the fund. Is it going to be able to deliver the income stream that they're telling me? It's all very accessible on a forward-looking basis. It's not an alpha strategy. It's really just about, if I'm going to give you $100,000 a year, I need to get $100,000 a year in bond coupons and maturities so I can get it back to you.
I mean, quite frankly, anybody could do this with ordinary treasuries, right? You could buy yourself a whole bunch of treasuries, ladder them all out, receive the income from some along the way, sell others to increase your distributions, handle all the record keeping. I mean, what basically LifeX has done is package it for you and make it very simple and easy and automated so that you're getting all the benefits of the strategy without having to make all those sausages.
That's exactly right. Effectively the simplest thing to do would be if you bought a zero coupon government bond maturing every single month all the way through the end year. So for our 2035 fund, you buy those all the way out to December 2035. It's 130 CUSIPs. And then you figure out, how much do I buy of each CUSIP so that when you combine the principal and the coupons of all the other bonds, I get the same amount of money every month. So The math's all doable. You just got to be willing to do 130 trades for every client and then to rebalance in and out if you want to make adjustments. If anybody does that for their client, I would love to hear from you. I've yet to really meet anybody who does bond ladders with more than one bond per year. And that's a great start, but the reality is people spend money every month. Feels good to get it every month. And when you buy a bond ladder where it's the same amount of principal every year, you actually haven't created a level income stream, because if you got 5 bonds in the portfolio, that first year you have 5 bonds paying you coupon, and in the last year you only have 1. So you have actually a declining income stream if you build bond ladders the way the industry historically has. And the real observation is it's just a lot of work to do bond ladders in a separate account and manage it individually. And so having that all packaged up in a simple offering as an ETF, when we tell people we're doing that for them for 25 basis points, most people say, gee, that'll save me a lot of time.
And that is the fee.
25 bips. Yep, that's correct.
Yeah, so because they're just treasuries, so it's not terribly complicated. I mean, this is really just the argument of ETFs in the first place, isn't it? I mean, why do people buy ETFs as opposed to building their own stock portfolios? Because the ETFs make it so simple, easy, and inexpensive.
Exactly right. You could build your own S&P 500 if you wanted to buy 500-ish stocks and rebalance. Yeah. It's interesting. I'm so glad you brought it up, Rick. There's an interesting thing that happened, which is before we had ETFs and mutual funds, people used bond ladders a lot. And fixed income really meant fixed income because you knew the coupons and you knew the principal. And when you turned, equity funds into equity ETFs, you kind of kept the product the same. But when you turn an individual set of bonds and a bond ladder into a bond ETF, it's not fixed income anymore because the income varies by quarter and it varies by year. So, we call it fixed income, but bond ETFs really don't deliver that value proposition. And, LifeX is the first one to really deliver you a fixed stream of income in an ETF. And to my mind, that should just be, the category of how people own fixed income in retirement.
So Joseph is asking who ought to be using this product. He's 60. He's saying, if I'm 60 years old, should I be using this, selling some of my current portfolio, or should I be using fresh money to invest in this? Who ought to be using it and how?
So it's really meant to be a replacement for cash or other fixed income. We're not generally expect people to say, hey, let me sell my equities and do this. And I would say if the client is in a category where they are actually sustaining their lifestyle based on cash flow or from selling principal out of the portfolio, and they own any other forms of core fixed income, that is a prime client that could benefit from this product. If you own an intermediate treasury fund and are selling from that periodically, I believe that laddering that treasury position is unambiguously safer and better for that client than what they have today. And so this is meant to be a drop and replace for that. That will create lower risk for them, great tax, and feel better for them as well. There is a use case, I think, as well for people that aren't retired and don't know they're going to spend. And I'll tell you, I personally am invested in the 2035 fund, not because I know I need to spend it, but just because I might. When you have, events in your life, you could change jobs, you can have, periods where your cash flow changes, or you might even just have a seasonal compensation structure where you get a bonus in January, but you still got to pay your rent in July and August. Having your portfolio generate cash flow is just strictly more flexibility for you, because if you don't spend it, you reinvest it. You're not worse off because you had that cash flow come back to you and give you that choice. But if you do end up needing the cash, it's really great to have that cash flow already built in. So for me, I think of having something like the 2035 ETF LDDR as about maybe a 5 or 10% allocation for a client of any age, just to have more reliable cash flow in the portfolio and more peace of mind for that client. And when that client really needs to be spending 3, 4, 5, 6% of the portfolio a year, that's where you really say, what am I doing if I own core fixed income that isn't laddered? It should really all be laddered at that point so that you don't have to rely on the tax inefficient ways of getting money out of the portfolio.
Well, that raises a really interesting concept, Nate, that if you're going to buy the 2035 fund, all the treasuries are 10 years or less, right? So you're laddering inside it somewhere between 30-day and 10-year, but you're not going beyond 10-year because that's the life of the fund. But the other funds, you have a fund that goes 40 years. There you are buying treasuries all the way out to 30-year bonds, right? So that's true laddering in that sense. So on that basis, why wouldn't an investor put all of their fixed income allocation into the 2040 fund? This way they'd be getting full treasury laddering. Treasury's the safest bond in the world. Why not just do that and call it a day?
To me, that's really the answer for like the core high grade fixed income. When you have other things in the fixed income book that are meant to be a bit more of, value added above risk free, corporate bonds, high yield bonds, it gets a little bit more gray area and it's more, kind of choose to taste based on how you think about it. To me, it's pretty attractive to think about a barbell strategy where when you're doing fixed income, be boring, simple, safe, predictable. And when you're trying to add value, go add a lot of value and cover all the spending needs so that people can feel safe when you really go swing for the fences and the rest of the portfolio. And so I personally find that a very simple way for people to think about building a portfolio. I got my cash covered. Now let's go make some money.
So one is asking, how often does the interest rate reset?
So the way you can think about it is the value of owning a share of LifeX is a known distribution stream per share per year. So for a 2035 fund, one share pays $10 a year, period. And what changes is what does that share cost? And so if today it costs $90 to get $10 a year, 10 divided by 90, there's your kind of 11% distribution rate. And that price changes in real time because it's an ETF and it's trading all day long. And so whenever you buy that ETF, you're getting the current fair market price of that $10 income stream through the end of 2035 based on the real-time price of the US government bond market. And so,
but once you've bought it, you've locked it in
exactly.
for the rest of the term.
Once you buy that share, you're just getting $10 per share per year. And you might pay $9, somebody comes along and pays $10, $8. You're all getting that same $10 per share. You just pay different prices based on market yields at the time and the remaining length of time when you bought it.
Got it. Mike wants to know if you work with, can a family trust do this?
Yes, a family trust. There's really no restriction on account types. Anybody who can buy an ETF can buy this product.
And JG wants to know what would happen to the assets if LifeX went belly up?
The beauty of the way ETFs are structured is you do not have credit risk to our company. You are the owner of the treasuries, not of some sort of a promise that we make you. It is very different than in an annuity where really what you are is a debt holder of the annuity company. You have their promise to pay and you don't own the assets. They own some general account of assets that they use to back up the promise. That's not what's happening here. You own a treasury bond ladder and the ETF is just the vehicle through which you own them. And if we were to go bankrupt and be gone tomorrow, you still own that exact same pool of assets. And there's a board of trustees that is independent from us. They're fiduciaries to the shareholder. And their job, if we were gone tomorrow, would be to say, we have some shareholders who own government bonds. What are we going to do to serve those shareholders? And they could say, let's just shut it down and give everybody all their money back. They could say, let's go hire another manager to come in and manage the treasuries. But whatever the treasuries are worth, that's your money, and you don't lose a penny of that just because we're gone.
And that's the same with any ETF. Again, it's just an ETF. There's nothing different here in that regard. It's one of the reasons people love ETFs and mutual funds because of that feature. Couple of questions about fees. You mentioned 25 basis points. Is that a subsidized limited time thing or different?
So it is a permanent contractual all-in number. And so any expenses of the ETFs that arise, like audit or custody, we pay out of the 25, and that's a forever number. It's not a short-term teaser. If you go look right now and kind of check every single ETF, you'll see some say 25, some say 50. The ones that say 50 are getting contractually reduced on February 19th. So check back on the 20th, and you'll see it say 25 basis points right there.
You've anticipated Jacob's question because he did look at the web and he did notice that. And he
Very
had a question
thorough.
about it.
Yeah, so that it's already been contractually reduced. It's just effective February 19. So that'll
Got it.
all be 25.
Got it. I'm just looking more at additional questions here that people are asking. That there's so much redundancy here because everybody's got the same concerns, same questions. Shows everybody's really thinking hard about this. Cody wants to know about record keeping requirements for IRA distributions. Anything particularly there that people need to be concerned about?
I think nothing out of the ordinary. Anything that you're already doing for other bond ETFs, it would be the same here, but this shouldn't present any new, different concerns. As a general matter, this doesn't create different forms of paperwork. If you own it at a brokerage, it's just a 1099. It's not a K1. There's no different paperwork. In a lot of ways, this is just a bond ETF, but it's a bond ETF that produces cash flows in a different way that's, in my opinion, a lot more useful.
Arthur's asking if the custodian has to adjust your basis to account for the return of capital.
It's a very astute question as well. The answer is yes. So every tax season, what's going to happen is you'll get a 1099 that's going to have just the interest portion in your income on the 1099. And there's going to be, return of capital that's happening as well. And during tax season, that custodian will adjust your basis so that if you originally paid $9 and you got $1 return of capital, they'll update your basis to be $8 so that if you sell in the future for $8, you actually don't even have a capital gain because of that adjustment. And that'll also make sure that the, profit and loss reporting is also reflective of the return of capital as well.
Brian would like you to elaborate. You mentioned it briefly earlier, the difference between the two different tickers, one a fixed rate of return versus the inflation protected version. Elaborate a little bit further on those.
Sure. So under the hood, they're both government bonds. It's just the difference between one buys fixed rate government bonds and the other one buys the inflation protected government bonds known as TIPS. And if $1 of the fixed rate product gives you $10 per share per year through its end year, the inflation protected version is going to give you $10 times an adjustment every year based on CPI. And we tried to kind of model the mechanisms of that adjustment off of Social Security, so it should feel very similar in terms of the magnitude of the adjustment each year and the timing of how that income stream grows over time to protect against inflation. They're the same exact expense ratio. So when you look at what's available, you know that it's just a function of what's available in the government bond market today.
And generally, I think the thinking typically is the longer out you're going, the more tips matter because of inflation. So would you generally agree that people looking at a 40-year fund ought to probably be thinking more along the tips version than the fixed version?
Yeah, I think that's exactly right, Rick. And I would say that's generally been the way we've observed it in the financial advisor community as well. People who buy the fixed rate income streams tend to buy shorter horizon. People who buy the inflation protected tend to buy longer horizon. And we've heard some people even think about the inflation protected version as an interesting way to think about things like long-term care, where they may not like the idea of buying long-term care insurance, but if you buy an inflation protected income stream using LifeX, you can reinvest it until you're 80 or whatever the age is. And if you end up having that long-term care need, you have that cash flow stream. But if you don't give up the money. It's not like long-term care insurance where it's kind of, call it use it or lose it. If you don't spend it on that, you can spend it on something else. You can hand it to your kids. It's your money.
just keep in mind you're self-insuring.
Exactly.
If you needed long-term care tomorrow, that strategy wouldn't work. But if you needed it in 30 years, it could much more effectively. Craig is wondering if there will be a replay of this because he wants to rewatch it. Yes, we will post the replay of this conversation as early as tomorrow. I think we'll get it up there, certainly by the end of the week, on our website at thetruthaboutyourfuture.com. And these questions, Nate, are really reflecting the fact that this is being received as a very intriguing idea that is innovative and totally different from what folks have generally had available to them in solving their dilemma of generating income that is highly consistent, that doesn't suffer from market risk, and can help them deal with their fears of longevity risk. So I think you're going to get an awful lot of continued conversation. I think you're going to get a lot of inquiries to LifeX from folks who are watching this. There are hundreds who are watching, and many more hundreds who have asked us already online to let them know when the replay is. So if somebody does want to reach you and your colleagues at LifeX, what's the best way for them to be able to do that?
So you'll get a follow-up email with all our contact information, so look out for that. The other thing I'll say, we're going to be doing an office hours session next Friday at noon, and feel free to join that. You'll get the information on that as well, and we'll run through some of the most prominent use cases. And we're also happy to kind of take Q&A, take specific client examples and challenges that you guys are confronting, and walk through how you could use LifeX in specific situations tailored to whatever's top of mind for you. So look out for the info for that, and hold kind of Friday lunchtime slot for next week.
And that's awesome. And if you haven't already, open your chat box, not the Q&A box, but the chat box, and you'll find LifeX's URL, their website, right there. Simple and easy for you to grab, so you can see just how these funds work, and you can reach out and contact Nate and his colleagues very easily. This has been really terrific information, Nate, and I'm really glad that you're here sharing it with us. I want to tell you about another event that we have coming up later this month, our annual Wealth Management Convergence. This is going to be just outside of Miami in Aventura, Florida, February 24 to 26. This is a broad-based conference with the investment strategies that advisors need to know today. Lots of CE credits, lots of opportunity to get direct conversation with asset managers and look at the latest and greatest strategies that are often not being talked about in the investment advisory field. So I encourage you to click that QR code, learn more about it, and love to see you in Florida at the end of this month for our WMC conference. Matt, Nate, again, thank you so much. This has been a real pleasure. Appreciate the content. And everybody, thanks for joining us. I look forward to seeing you all again soon.
Thanks for having me, Rick.
Sure thing, Nate.